commercial program is brought to you by TD Wealth.
Tonight, it was a banner year for investors long the markets. The S&P was up 30%, but something was different. The volume. If you look at the volume on the New York Stock Exchange, it was half what it was in 2007. How come? Big changes to how the market worked after the 2008 crisis. So what exactly changed, and what will it mean to you as we move forward in 2014? You might be surprised to hear the answers. As always, we go to the smartest minds on the street. Our panel, Tim Wiggan, CEO of TD Asset Management, and Robbie Pryde, Vice Chair and Head of Equities at TD Securities. All that ahead on Money Talk. Hello and thank you for joining us tonight. My goal every week on the show is to cut through all the noise from the 24/7 news cycle and try and help you focus on what's important to your investment strategy. Nothing has changed tonight. 2013 was kind to those who invested in the U.S. market. As we just told you, the S&P 500 ended the year at an all-time high for the first time in a very long time. Yet trading volume, at least on the New York Stock Exchange, is at a 5-year low. So is low trading volume a red flag for retail investors, or is it just more inside baseball stuff? Helping us to understand that, Tim Wiggan, Head and CEO of TD Asset Management, and Robbie Pryde, Vice Chair and Head of Equities at TD Securities. First, I have to say, it is so nice to have you here. It's very nice to have you here, Tim.
Thank you for having me.
It is extra nice to have you here, Robbie, because you do not make a habit, I know, of doing meetings. So it's great to have you here. And the context for people here as well is that we have the buy side and the sell side here at the same time. So this is an interesting conversation we're going to have tonight. And I'm going to shut up soon, but I just want to say, the reason we're having this conversation is you and I were talking, I think it was last year, about what's happening in the market right now. And you really illuminated to me what has changed since 2008. So let's start there. What actually happened in the financial crisis of 2008 that affects what's actually how the markets are trading today? Yeah,
well, obviously a tremendous amount of change has occurred since 2008, and there's many different facets of that and many different things that we could focus on. What I think that I would point out from a retail perspective that I believe is a certain outcome of 2008 is the average investor has become less asset class focused and more solutions focused. And by that I mean maybe less concerned about how their portfolio is doing relative to an index, be it the S&P or the TSX, and more focusing on what their goals are.
Yeah, I want to do a lot of skiing at 65.
I want to retire at 65. Yeah. I want to focus on accumulation and decumulation starting at 65. I want to send my son or daughter to university. How do I get there?
Yeah. So that's a big one. And the other one that we talked about was volume. There's just the volume in the market, as I was just talking about, it's just not what it was.
It isn't, and one area that we have specifically focused on volume as it relates to investing on part of our client base is on the corporate bond side. We've seen a doubling of the outstanding for corporate bonds since 2002, well over $9 trillion in outstanding.
I just want to back up there for 1 second, because that hunger for income that people have had, they've gone to the corporate debt market to get it, and again, this is ballooned. It's a very large market.
Yes, it has ballooned. I think that if you look at the demographic and you look at the demographic specifically of who has the investable dollars, they're that much older, they've survived a financial crisis, but they still need income. And so one of the things that we're very concerned about and want to monitor is that we don't translate interest rate risk into credit risk. Mm-hmm. And by that I mean pushing too far out the risk curve as it relates to corporate exposures. The issuance has gone straight up, as I mentioned. The secondary or underlying trading volumes haven't necessarily kept pace. And what that really means from an investment perspective is we need to be conscious of maturity in a lot of cases, accepting that we'll own a specific credit to maturity. Mm-hmm. And we need to have a real emphasis on credit analysis to make sure we're comfortable with those positions.
I want to come back to that one, but I want to stick with the volume piece too, because there's a whole bunch of reasons why we're just not seeing the same volumes in the market that we did before. And you've got some good perspective on that as well.
Yeah, I think there's a number of reasons. Tim's touched on some key points. Mm-hmm. I think if we can just draw it to Canada, certainly a big part of the Canadian market is the resource side of things, so materials, energy stocks. And in late 2010, early 2011, up until that point, Canada had been more active, and our market's probably outperforming a lot of other markets. And at that point, in early 2011, commodities rolled over. partly driven off of what was happening overseas in China. And with that, it really does affect the Canadian markets. So as commodities went lower, commodity-based stocks went lower. And as people exited, not just retail investors, but international investors, European, American investors that were fairly heavily invested in Canadian commodity-based stocks, exited our marketplace. So volumes did start to diminish and dry up. I think from the point in early 2011 to now, we're running about 60% of on the retail volume side of where we were. In the U.S., it's not quite as bad. It's tracking about 80% of where the peak was back 2, 3, 4 years ago in the U.S. And I think also you have to attribute part of it, Kim, to investors really just sort of being scared out of the market, the equity markets back in 2008. And so with that, there was a move from equities into other asset classes, certainly fixed income, cash for a lot of investors, GICs. Some went under the mattress because of the shock of what they went through in late 08 and early 09. So as you move out of equities into other asset classes, that obviously affects volumes. And on top of that, I think just the marketplace in general was shaped differently. It was a credit bubble. It fueled a lot of asset classes, including equities. And as that bubble burst and things started to transpire in marketplaces, well, the exits were the easy place to go. So.
Right. Go ahead, Tim.
And I'll put some numbers there. I completely agree with Rob's point. If you look at the asset allocation on the part of Canadian pensions, the other category, which is essentially infrastructure, real estate, and private equity, that's gone from 8% to 28% since 2001. U.S. and Canadian equities have both dropped roughly in half in terms of the percentage of the overall AUM that's being allocated. So that's real dollars that are shifting, that are impacting volumes.
With all those shifts that are happening, and as we move ahead, and whether it's in corporate debt market or in equities, as we go out over the next year, 2 years in trading, I just, and we've spoken to about liquidity provides a cushion, I guess, for investors. When there's more liquidity, there's more room, you can sell, you can do things as a big institutional manager. But if there's less volume, that means less cushion, and I would expect more volatility. So is that something we should expect moving ahead?
Well, I think basically what we're talking about is, in its most simple form, is participation in the market. If there's fewer participants, there can be generally higher volatility. I think maybe one warning shot across the bow was the taper tantrum in the summer months when the idea of a reduction in quantitative easing or stimulus was first introduced, rates backed up, and credit spreads actually increased. You typically wouldn't see that. You would actually see a compression. So that could be a bit of an indication, less participation in the market, less cushions or shock absorbers.
And part of it also, I think, too, is the market is more dispersed than it was, right? I mean, you have high-frequency trading, you have different marketplaces now, too, so there's different places for people to trade than there was before.
Yeah, that's true, Kim, but the trading is still all consolidated, so the volume's either there or it's not. High-frequency trading has been a hot topic. It's a full show. We won't deal with it today, but
we'll get you back for that one.
Yeah,
so.
Look forward to that. But I would say that high-frequency trading has more or less taken over the market-making role, not just in Canada, but globally. And it's an important role, and I would say that volatility can be a good thing for high-frequency traders. But when it comes to more difficult markets like we had been going through, I think you migrate to volume, and larger cap stocks tend to trade in a much more liquid fashion than smaller cap stocks. So that obviously affects volumes, marketplaces, and in particular Canada, where we have, again, that large resource sector where there's a lot of small cap names in our venture exchange, et cetera.
So does that mean, like, moving ahead, then we are going to see, like, is less volume the new normal? Is that what we can expect in the market, or is this somewhat cyclical and this could change as well?
I think there's an element of cyclicality for sure. I believe that volumes can recover. I
guess it depends on confidence too, right?
Yeah, it does. And this is an elongated super cycle of proportions that we haven't seen before. We haven't seen a deleveraging. Tim and I haven't lived through a deleveraging like this. Basically, no one has. So you don't really know what to expect. It's not a typical cycle. So because of that, it's a little harder to predict, Kim, in terms of when things will turn. I will say for Canadian investors, though, until you get the commodity turn, because at the end of the day, financials make up roughly a quarter of the Canadian market, and the resources make up about another quarter, and even expand beyond that. And until that part of our market turns, we're not going to see the really robust volumes that we're used to back in 05, 6, 7, 8.
All right, stay with us. When we come back, we're going to be talking about that very thing that Robbie just mentioned, the deleveraging of the market. What happens when people start to get back in? What happens when that stimulus really starts to come out? Talking about that coming up. And a reminder, any comments or questions, we do love to hear from you. Send them to moneytalk@bnn.ca so we can answer them for you on the show, or we will find the right person to answer them for you. More Money Talk when we come back. Welcome back. My guests are Tim Wiggan, Head and CEO of TD Asset Management, and Robbie Pryde, Vice Chair and Head of Equities at TD Securities. We're talking about what's going on in the markets right now, how it can affect you as we move forward. We were talking about the fact there's less volume in the market and how that has changed. One thing, though, is there's a whole lot more liquidity than there ever has been because of QE that was started so long ago. But we actually today got the minutes from the last meeting, which was the first time we heard about the tapering would be tapered by $10 billion. By $10 billion, again, they're spending $85 billion a month to insert into the economy. Was there anything in the minutes that came out today that was notable, or it makes you just think they were on track for what the plan was? Well,
I think there'll be streams of analysts and analytics around what it means. I took 2 or 3 observations away from the Fed minutes. One was there was a discussion around how effective the bond buying program was, what the incremental impact was. 2, clearly there's been some impact in the economy. GDP is trending up. It's not where they would like it to be, but it's moving in the right direction.
It's better than Canada.
That's right. Unemployment has dropped to 7%. It's not 6.5, but it's moving in the right direction. And there was also some commentary around maybe unintended consequences around risk-taking activity. But I do think, and it's something I think most are aware, but I think it's important to stress that we're talking about a deceleration in the stimulus program, moving from $85 billion to $75 billion per month.
It's deceleration, but you're still adding
exactly
$75 billion a month.
Exactly right.
But I know that you and I chatted earlier, and you think that perhaps the focus should be elsewhere, but they want the focus to be elsewhere.
Yeah, that's an interpretation.
That's fair enough.
The Fed's not out saying that.
Yeah.
But I think I'm agreeing with Tim. I think that from the September minutes to the December minutes, there was a relatively big change in attitude, and that was all in a response to how the economy was doing. And I think there's now more confidence today that the U.S. economy is actually recovering. Global trade is picking up. Industrial production numbers are improving. So these are all fairly significant indicators that are being watched fairly closely. We have the non-farm payrolls coming out on Friday, and that'll be it's expected to be good, and it'll be
ADP numbers were good today.
Yeah,
so.
it'll be fairly heavily watched. So I think that the Fed, I think it's proving out that tapering is fairly well factored into the marketplace. It's expected now. In fact, in the minutes, if I remember correctly, I think they said by later in 2014, tapering will be done. And I think really where the Fed has been trying to push investors, the markets, is to be focused on the short end of the curve. So short rates.
Why is that so important? Again, I want you to speak to me again. Not as an insider, but as someone who's watching and a retail investor. Why should I be concerned about the short end of the curve?
Well, I think it's probably a great measurement of inflation, and there's a lot of focus on inflation. It's not where the Fed wants it to be. Inflation, their target is around 2%. And same as in Canada, and it's running below that.
Right.
And that's concerning. It's you want the economy to be growing more robustly than that.
People always worry for me that they think it's prices or products cost more, but it's also wages. Wages go up when you have inflation.
Right.
But anyway.
So the short end of the curve is not going to rise until you see inflationary pressures pushing it there. So I think the the message is that for a fairly extended period of time, rates are going to remain low. If the top end of the curve gets pushed higher, that's fine. I think that's a natural progression in terms of how the economy is behaving.
It's a good point. I think part of the language that the Fed uses is that they would maintain stimulus in the Fed funds rate well below 6.5% unemployment. So they're basically telling you the short end of the curve.
And they're being very careful. Said well below 6.5% now.
So I think they're basically telling you that it will remain a accommodative environment.
So tell me, we've been living in this area of depressed rates for a long time, and we have this stimulus. How has that changed what you do? How's that changed what you do and the kinds of things that you're involved in? Because as that unwinds, it's going to change again. And you said we've never been here before. So how is that? I mean, you mentioned interest rate risk versus credit risk, and I think that's a really good point.
It's a really broad question and probably a show unto itself. But one of the things that you
guys
clearly
keep programming my shows for me, but anyway.
Well, it's so one of the things clearly you've seen, I believe you can argue you've seen the bottom of a 30-year bond market. So the yields have bottomed out after a 30-year bull market. So we're not expecting rates to shoot higher, more of a lower for longer. But if rates are on the margin moving up as opposed to down, for instance, or an example of how things have changed, it would change the nature of an equity, for instance, that you would invest in. So you'd be more likely to buy a dividend growth story as opposed to a high dividend, low growth equity.
Right.
So that's an example. I've already referenced that we're very mindful of maybe substituting the interest rate risk for credit risk. We've seen record issuance in junk bonds this year. Non-traditional fixed income funds were up 76% in terms of AUM. So you're seeing all sorts of changes to traditional fixed income bond funds are under redemption, but it's moving into global and high yield. It's moving into balanced product. The thirst for yield is changing form rather than disappearing.
Are people positioned, do you think, retail investors, again, who knows, every profile, different person, but are they positioned properly for this, do you think?
Well, my rule of thumb is the bulk of the market isn't positioned correctly.
Yeah.
The way that I think a lot of people think of the risk spectrum, if you will, you have fixed income seen as lower risk, and equity seen as higher risk. What we are definitely seeing is that middle bucket, which is obviously balanced fund. That represents close to 50% of the retail AUM, so the total mutual funds outstanding. And on most months is accounting for 90 to over 100% of net sales, because of course you have the redemption number in the figure from traditional fixed income. So the change is happening. But you're unwinding fund flow that have occurred over 30 years, so it takes time.
I've only got about 30 seconds here. He took up all your time right there, so you get mad at him later on. But in terms of how QE's changed, the world, the landscape that you deal in, what's been the biggest thing that you've noted?
Well, I think Tim has touched the points. It's really it's what the investor is focused on. So yield has been the sort of the flavor of the day, and continues to be. Clearly, the retail investor, the institutional investor, has been searching for growth, though, and it's obvious in the markets and the way the markets perform, especially in the U.S., where they've had a great year, 30% plus, less so in Canada. But there certainly has been a move towards searching out growth and less emphasis on preferred shares. Utilities underperformed this year. So I think that's been a fairly big change, Kim.
All right, stay with us when we come back. We're going to find out what they think the trends are for next year, some ideas about what's coming. Stay with us, more right after this. All right, welcome back to Money Talk. My guest tonight, Tim Wiggan, Head and CEO of TD Asset Management, and Robbie Pryde, Vice Chair and Head of Equities at TD Securities. Again, great to have both the buy side and the sell side here at the table. And the question was, as we went into break, what are the things we're going to be watching next year? What are the trends? Where are the opportunities? Robbie, let's start with you. Not just next year. I'm not going to hold you to 1 year, but the next few years. As everything unwinds that we've been talking about unwinds and the landscape changes, what looks interesting to you?
Yeah, so some things do look interesting. It's hard to forecast because it's,
I will not hold. I know you're. I'm giving you a long time span here. 10 years.
Yeah, so I think 2013 was a breakout year for markets, and it was the best year since '97, I think, south of the border. And why was that? I think that what you saw was a multiple expansion in the marketplace, and that's certainly transpired in 2013. So the performance last year in the U.S. of roughly 30%, about 21 to 22% of that was multiple expansion, and 7 to 8 was actually earnings growth.
Right.
And then as you shift into this second year of what we'll call a recovery in the U.S. economy, then the emphasis is on actually earnings growth. And the coming year will be sort of a show me to the marketplace. The multiples have expanded. Now the earnings have to come in underneath to push that. So, I think it'll be hard to repeat the type of performance south of the border that we had this past year. In Canada, we could potentially outperform this year. It's probably early. But I think there should be a lot of focus on the U.S. dollar for a Canadian investor.
Which is hard. If the U.S. dollar goes up, it's not great for commodities.
It's not. So if we are in a scenario where the U.S. dollar is strong, well, that's going to prolong the underperformance of the Canadian resource sector for sure. Yeah. And if the dollar, for whatever reason, decides that it's going to go the other direction, then it's probably going to be a decent year, or maybe second half of the year for commodity-based stocks.
What about, I know we talked about single stock selection, because you said there's a lot of ETF buying right now in creation, and that might leave an opportunity with single stocks. Yeah,
it's debatable, but I think it's a bit unclear, but I think you could make an argument that ETFs have been around for a while, and it wasn't a phenomenon that was created from 2008. It was there before.
No, long before,
lots of growth. Great asset class. But I think it probably caused certainly some retail investors to, I'll say, get lazy towards paying attention to.
Well, it's easy to be passive when the markets are going up, right?
Right. And I think that it does lead to an opportunity of actually active money management and single stock selection. And it's just not driven off of ETFs, but I think it's driven off the market dynamics as a whole. And I do think it is a year, and last year was actually a year. The average Canadian money manager last year, in 2013, outperformed the benchmarks. And there was more first and second and third quartile outperformance in 2013. And that tended to be the money managers that focused on stock selection. And I think you're going to see that continue into 2014.
Intriguing. Tim, how about you? What do you see for?
Well, I think I'll build off what Rob has mentioned, and that's it. I believe the trend towards solutions or fund to funds, active asset allocation, will continue.
Yeah.
Over the course of the last year, fund of funds have been outselling standalone funds roughly 3-1. And so I don't actually think of it as ETF versus actively managed. I think of it, are you addressing what the client is solving for, be that retirement, be it a child's education.
Right.
So you need the individual pieces, but you also need the expertise around asset allocation to address that need, which I think is really showing up in the retail fund flow, be it balanced, which is dominating the outstanding or the net sales, or be it the fund of funds versus standalone funds. Briefly on the institutional side, it's completely different. Better markets generally leave plans or pensions in a better funding position.
Right.
Higher rates lower the present value of their liabilities, so that could cause them to do something called liability-driven investing, where they're actually matching off their liabilities with fixed income. It could lead them to move passive fixed income to active.
Right.
There's all sorts of implications, but generally,
because I think people think great rotation in the retail space. They
go completely different.
Completely, it's the opposite in institutions.
Yeah, and we're seeing that play out.
Yeah.
In a rising rate environment, even if we're not again calling for it to skyrocket higher in the short term. There's more a tendency to allow your manager some flexibility around your duration call than you would need to do in a falling rate environment. Obviously, you can realize returns passively.
Any personal resolutions for 2014? Kidding. Put you on the
spot.
Take
up jogging.
Nice. Running?
I already run. I'm just going to keep my head down.
Robbie Pryde, Tim Wiggan, thank you so much for coming. Great to have you here.
Thanks for having me
here.
Tim Wiggan is CEO and head of TD Asset Management, and Robbie Pryde is vice chair and head of equities at TD Securities. Of course, buy side and sell side of the table. That doesn't happen too often, so it was really great to have them both here. Well, next week I'm going to be talking to Satish Rai, Chief Investment Officer of TD Asset Management, about what big trends he sees brewing for 2014, as well as his investment strategy for the year. here. And of course, he always focuses a lot on fund flows and what's happening there. So we'll get a sense of what his outlook is for 2014 and where the opportunities is. Thank you for joining us tonight. If you have any questions on anything you've seen, or if you would like someone to take a look at your portfolio, or if you have some planning questions, please email me at moneytalk@bnn.ca. I'll get you in touch with someone who can answer those questions for you and any other questions you might have. Take a look at that portfolio to see if it matches your objectives. Thanks very much, and we'll see you again next week.
The preceding paid commercial program was brought to you by TD Wealth.